You need to see what just happened in the gold market. Because what we're witnessing right now, this doesn't happen often. And when it does, fortunes are made or lost. Gold just shattered through a resistance level that's held for months. We're talking about a technical barrier that's been tested, rejected, tested again, rejected again, until yesterday, when it finally gave way. And here's what most people don't understand about resistance breaks like this. They're not just lines on a chart. They're psychological barriers. They're where institutions have been waiting, where algorithms are programmed to trigger, where billions of dollars in capital sits on the sidelines watching, waiting for confirmation. And that confirmation just arrived. Let me show you exactly what happened. Gold was trading in a range between $2,640 and $2,678 for weeks. Every time it approached that upper boundary, sellers appeared, like clockwork. The market would push up, test that level, get rejected, fall back down. This created what traders call a resistance zone, a ceiling, a line in the sand where the market kept saying, "Not yet." But something changed in the last 48 hours. The buying pressure intensified, and instead of getting rejected at 2,678, gold blew through it, closed above it, held above it. That's the critical part. Anyone can spike through a level for a few minutes. What matters is the close, the confirmation, the statement that says, "We're not going back." Now here's where this gets interesting, because this isn't happening in isolation. Let me walk you through what's converging right now. What's creating this perfect storm that just launched gold through resistance? First, look at what central banks are doing, not what they're saying, what they're actually doing. The World Gold Council just released data showing central banks bought 183 tons of gold in the third quarter alone. That's the highest quarterly purchase in over a year. But here's the part that should make your ears perk up. They're not slowing down. They're accelerating. China's central bank, after a 6-month pause, just resumed purchases. Poland added another 21 tons. Turkey continues accumulating. India's building reserves. Why? Because they see what's coming. They understand that the dollar's dominance is being challenged in ways we haven't seen since Bretton Woods collapsed in 1971. And they're positioning accordingly. When central banks move this aggressively into gold, they're not speculating. They're not trying to make a quick profit. They're protecting their nation's wealth from what they see on the horizon. Second, look at the technical setup that just triggered. Gold was forming what's called a falling wedge pattern throughout November and early December. This is a bullish formation. It's what happens when selling pressure gradually weakens while support holds firm. The price makes lower highs, but those highs are declining at a slower rate than the lows. It creates a wedge shape that narrows over time. And when it breaks to the upside, which it just did, it typically leads to explosive moves. But there's more. The 20-day moving average, which gold briefly dipped below in late November, has now been reclaimed. The 50-day moving average is providing support. And the 200-day moving average, the granddaddy of all trend indicators, is sloping upward. This is what technical analysts call a golden cross setup. When shorter-term averages cross above longer-term averages with all of them pointing up, it signals strong momentum. Now let me tell you what happened the last time we saw a setup like this. It was early 2024. Gold broke through resistance at $2,100. Everyone thought that was the top. Gold's overbought, they said. It needs to correct, they said. Instead, it ran to $2,450 in less than 4 months. A 16% gain. And the people who waited for the pullback? They watched from the sidelines as the train left the station. Here's what's different this time. The fundamental backdrop is even stronger. Let me explain why. The Federal Reserve just signaled they're done with aggressive rate hikes. Their latest projections show cuts coming in 2025. Now, you might think, but rates are still high, that should be bad for gold. Wrong. What matters isn't where rates are, it's where they're going. Gold doesn't wait for rate cuts to happen. It anticipates them. It moves in advance, and right now, with real yields starting to compress, with inflation expectations rising again, with the dollar showing weakness, gold is doing what it always does. It's front-running the policy shift. But there's something else happening that most analysts are missing. Something in the physical market that's creating pressure you can't see on a price chart. The premium for physical gold over paper gold is widening. In Asia, buyers are paying $20 to $30 over spot price to get their hands on actual metal. That spread used to be $5 to $10. When physical premiums expand like this, it tells you something critical. There's a shortage developing, not of paper contracts, of actual gold. See, here's how the gold market really works. Most of what trades is paper, futures contracts, ETF shares, derivatives. For every ounce of physical gold that exists, there are probably 100 paper claims on it, maybe more. This works fine as long as everyone's happy trading paper, but when people start demanding physical delivery, when they want the actual metal in their hands, the system gets stressed, and those premiums start rising. This is exactly what happened in March 2020. Remember, when COVID hit and the world locked down, gold premiums exploded. You couldn't find physical gold anywhere. Dealers were sold out. Mints couldn't keep up with demand. And the price? It went from $1,600 to $2,070 in 5 months, a 29% gain. Because when the paper market and the physical market disconnect, the physical market always wins. Always. And we're seeing early signs of that disconnect forming again right now. The COMEX warehouse stocks, where the big futures exchange stores its gold, have been declining. Not dramatically, but steadily. Week after week, more gold is leaving than arriving. That's a warning sign. It means someone, somewhere, is taking delivery, converting paper into metal. And when that trend accelerates, prices tend to follow. Now, let me connect this to something that affects you directly. Your retirement accounts, your savings, your purchasing power. Because what's happening in the gold market right now is a symptom of a much larger problem. A problem that's been building for years and is finally coming to a head. The U.S. national debt just crossed $36 trillion. Let that sink in. $36 trillion. That's $36,000 billion. The interest payments alone are now over $1 trillion per year. More than we spend on defense. More than we spend on Medicare. And it's accelerating. Every time the government needs to roll over maturing debt, they're doing it at higher interest rates than before. This creates a debt spiral. More debt requires more interest payments, which requires more borrowing, which requires more interest payments. There are only 3 ways out of this. Cut spending dramatically, raise taxes dramatically, or inflate the debt away. Which one do you think is most likely? Which one is politically feasible? Which one can happen without Congress having to make hard choices? Inflation. That's the path of least resistance. That's what every government in history has chosen when faced with unpayable debts. And gold knows this. Gold has seen this movie before. In the 1970s, when the U.S. abandoned the gold standard and inflation took off, gold went from $35 to $850, a 24x gain. In the 2000s, when the Fed kept rates too low for too long and created the housing bubble, gold went from $250 to $1,900, a 7.6x gain. And now, we're in the early stages of what could be the biggest monetary debasement in history, not just in the U.S., globally. Every major economy is drowning in debt. Every central bank is trapped between inflation and recession. Every government is choosing the printing press over austerity. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I put together a free guide that covers exactly how to get physical gold into your retirement account without triggering taxes or penalties. It's in the description below. Worth checking out if you're concerned about protecting your purchasing power over the next decade. Because what's coming is going to separate those who prepared from those who didn't. Anyway, back to this resistance break and what it means for where gold is headed next. When gold breaks through a major resistance level like this, it typically doesn't just drift higher. It tends to move in what traders call an impulse wave, a sharp, sustained move that catches people off guard. And there's a mathematical reason for this. All those traders who were short gold betting it would get rejected at resistance again now have to cover their positions. That means buying. All those algorithms that were programmed to sell at 2,678, now they're flipping to buy signals. That means more buying. All those institutional investors who were waiting for confirmation before entering, now they're getting that confirmation. More buying. This creates a feedback loop, a cascade, and it's just beginning. Let me show you where this could go. If we measure the height of that falling wedge pattern that just broke from the widest point to the apex and project that distance upward from the breakout point, we get a target around $2,150. That's a 6.5% move from current levels, but that's just the technical target, the conservative estimate based on pattern recognition. What if this is something bigger? What if this isn't just a technical breakout, but the beginning of gold's next major leg higher? Let's look at the fundamental case for where gold could go over the next 12 to 18 months. Gold's all-time high was around $2,450 hit in May 2024. We're already approaching that level again. But here's what most people don't realize. Adjusted for inflation, gold's real all-time high was $850 in January 1980. In today's dollars, that's equivalent to about $3,200. So gold would need to reach $3,200 just to match its inflation-adjusted peak from 45 years ago. Think about that. Despite all the money printing, all the debt accumulation, all the geopolitical chaos of the past 4 decades, gold still hasn't exceeded its 1980 high in real terms. That's about to change, because the conditions that drove gold to $850 in 1980, high inflation, currency debasement, geopolitical instability, loss of confidence in government, those conditions are returning, but amplified. The debt levels are higher, the money printing is more extreme, the geopolitical tensions are more complex, and the public's trust in institutions is lower than it's been in generations. When gold finally breaks through that inflation-adjusted ceiling, when it exceeds $3,200 and confirms that we're in a new paradigm, that's when the real move begins. Because that's when the psychology shifts. That's when gold stops being seen as a hedge and starts being seen as the only safe haven. That's when the institutional money that's been sitting on the sidelines, the pension funds, the sovereign wealth funds, the family offices, that's when they start allocating serious capital. And here's the thing about institutional money. It moves slowly. But when it moves in size. A pension fund doesn't buy 100 ounces of gold. It buys 10,000 ounces. A sovereign wealth fund doesn't allocate 1% to gold. It allocates 5% or 10%. And when you're managing hundreds of billions or trillions of dollars, even a small percentage allocation represents enormous buying pressure. This is what happened in 2010 and 2011. Gold broke through $1,200, which was its previous all-time high from the 1980s in nominal terms. And once it broke through, once it proved it could make new highs, the institutional money flooded in. Gold went from $1,200 to $1,900 in less than a year, a 58% gain. And it would have gone higher if central banks hadn't intervened, if they hadn't started talking about tapering QE, if they hadn't temporarily restored confidence in the system. But they can't restore confidence this time, because the problems are too big. The debt is too large. The imbalances are too extreme. And everyone knows it. Look at what's happening in the BRICS nations. Brazil, Russia, India, China, South Africa. They're actively working to reduce their dependence on the dollar. They're settling trade in local currencies. They're building alternative payment systems. They're accumulating gold at record rates. This isn't a conspiracy theory. This is official policy. China has been buying gold every month. Russia has been buying gold for years. India just announced plans to increase its gold reserves. Why? Because they're preparing for a world where the dollar is no longer the undisputed reserve currency, where international trade isn't automatically denominated in dollars, where central banks need an alternative asset that isn't someone else's liability, and that asset is gold. Now, some people will say, but gold doesn't pay interest, it doesn't generate cash flow, it's just a rock. And they're right. Gold doesn't pay dividends, it doesn't pay interest, it just sits there. But that's exactly the point. Gold is no one's liability. It can't be printed, it can't be debased, it can't be defaulted on. In a world where every currency is being devalued, where every bond carries counterparty risk, where every financial asset is dependent on the system continuing to function, gold is the ultimate insurance policy. And insurance becomes more valuable when the risks increase. Right now, the risks are increasing faster than most people realize. The commercial real estate market is cracking. Office buildings in major cities are sitting empty. Valuations are down 30% to 40% from their peaks. Banks that lent against those properties are sitting on massive unrealized losses. We saw what happened with Silicon Valley Bank and First Republic when their bond portfolios went underwater. Now imagine that happening across the commercial real estate sector. The potential for a banking crisis is real. The geopolitical situation is deteriorating. The war in Ukraine continues with no end in sight. Tensions between the U.S. and China are escalating. The Middle East is a powder keg. Iran and Israel are on the brink. Any one of these situations could explode into a broader conflict. And when geopolitical risks rise, gold rises. It's been that way for thousands of years. The political situation in the U.S. is increasingly unstable. We're more divided than we've been since the Civil War. Trust in institutions is at all-time lows. The 2024 election is shaping up to be contentious regardless of who wins. And when political stability is questioned, when people start wondering if the system can hold together, they move money into hard assets, into things that can't be voted away or legislated out of existence. All of these factors are converging right now. And that resistance break we just saw in gold, that's the market's way of saying, we see what's coming. That's the smart money positioning ahead of the crowd. That's the signal that the next major move is beginning. Let me tell you a story about 2008. In the summer of that year, gold was trading around $900. The stock market was still near its highs. Most people thought the subprime crisis was contained. It's just a few bad mortgages, they said. The Fed has it under control, they said. But gold knew better. Gold started climbing in July. By September, when Lehman Brothers collapsed and the world realized how bad things really were, gold was already at $950. And while the stock market crashed 50% over the next 6 months, gold held its ground. By 2011, it was at $1,900. The people who bought gold in the summer of 2008, before the crisis became obvious, they protected their wealth. They saw their purchasing power preserved while everyone else watched their portfolios get cut in half. We're in a similar moment right now. The cracks are forming. The warning signs are flashing. But most people aren't paying attention. They're focused on the stock market hitting new highs. They're listening to the Fed saying everything is fine. They're believing the narrative that we've achieved a soft landing. But gold is telling a different story. Gold is breaking through resistance. Gold is making new highs. Gold is saying something's wrong and you need to prepare. Here's what you need to understand about resistance breaks in bull markets. They're not the end of the move. They're the beginning. When gold breaks through a major resistance level during a bull market, it typically runs much further than anyone expects. Because resistance becomes support, that level that was so hard to break through that now becomes the floor, the new baseline, and the market builds from there. So when gold broke through 2,678, that level now becomes support. If gold pulls back, which it might in the short term, because markets don't go straight up, that's where buyers will step in. That's where the dip buyers will appear. That's where the institutions who missed the initial breakout will get their second chance. And once that support is tested and holds, once the market confirms that we're not going back below that level, that's when the next leg higher begins. The target? Based on the technical patterns, based on the fundamental backdrop, based on historical precedent, I think we're looking at $2,850 in the near term. That's the first major target. But beyond that, if the macro situation continues to deteriorate, if inflation stays elevated, if the Fed is forced to cut rates more aggressively than expected, if geopolitical tensions escalate, we could see $3,000 by mid-2025. And if we break through that inflation-adjusted all-time high around $3,200, all bets are off. We could be looking at $3,500, $4,000, maybe higher. I know that sounds extreme. I know some of you are thinking, that's too bullish, that's unrealistic. But let me ask you this. In 2019, if I told you gold would go from $1,400 to $2,070 in 18 months, would you have believed me? In 2010, if I told you gold would go from $1,200 to $1,100 in less than a year, would you have believed me? In 2001, if I told you gold would go from $250 to $1,700 over the next decade, would you have believed me? The moves in gold, when they happen, are always bigger than people expect. Because gold doesn't move on fundamentals alone. It moves on fear, on uncertainty, on the realization that the system isn't as stable as we thought. And once that fear takes hold, once that uncertainty spreads, the moves accelerate. We're seeing the early stages of that acceleration right now. This resistance break is the starting gun, the signal that the race has begun. And the question you need to ask yourself is this: are you positioned for what's coming? Or are you going to wait until it's obvious to everyone, until gold is at $3,000 and the financial media is finally talking about it, until your neighbor is buying gold and telling you about it? Because here's what happens when you wait. You pay higher prices. You buy at the top of the move instead of the beginning. You miss the gains that the early movers captured. And worst of all, you might not be able to get physical gold at any price. Because when the crowd finally wakes up, when everyone realizes they need to own gold, the premiums explode, the dealers sell out, the mints can't keep up, and you're left scrambling. I've seen this happen twice in my career, in 2008 and in 2020. Both times physical gold became nearly impossible to find. Both times premiums went through the roof. Both times people who waited paid dearly for their hesitation. And both times the people who positioned early, who bought when gold was breaking through resistance, who understood what the market was telling them, they were the ones who preserved their wealth. This is your moment. This resistance break is your signal. The market is telling you something important. The question is, are you listening? Look at the bigger picture here. We're not just talking about a trade. We're not just talking about making a quick profit on a gold position. We're talking about protecting your purchasing power in an environment where currencies are being systematically devalued, where the cost of living is rising faster than official inflation numbers suggest, where your savings are losing value every single day just sitting in a bank account, earning 0.5% interest, while real inflation runs at 5% or more. Gold isn't just an investment, it's insurance. It's a hedge against the incompetence of central bankers and the recklessness of politicians. It's a store of value that survived every empire, every currency collapse, every financial crisis in human history. And it's telling you right now, through this resistance break, through this technical signal, that you need to pay attention. The explosion is just beginning. The breakout is confirmed. The momentum is building. And the smart money is already positioned. The question is, will you join them? Or will you wait until it's too late?